Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today I'm joined by a special guest, Kevin Guttman. Kevin is a senior mortgage broker, reverse mortgage specialist, and three-time Amazon best-selling author with over 20 years experience in home financing. As one of only 218 certified reverse mortgage professionals nationwide, he's known for his integrity, transparency, and people-first approach. With over 100 five-star reviews and an A+ Better Business Bureau rating, Kevin simplifies the loan process for senior homeowners, offering expert insights and real-life stories. A lifelong learner with 3 master's degrees, he's also a devoted LA Lakers fan, world traveler, and passionate community volunteer. Kevin, welcome to the show.
Thank you, Marc. I'm so glad to be here.
All right, so I'm excited to have you here. I'm excited for today's topic. Many adult children worry about their parents' financial security in retirement. I see this all the time where, their parents are getting older. They're worried about, will their parents be secure? You specialize in something called retirement mortgages. Can you explain what a retirement mortgage is, how it works, how is it different than that traditional mortgage, home equity loan, or reverse mortgage, which people may be a little more familiar with?
Yeah, it's a mortgage where a lien is recorded against the home, doesn't need to be paid back until the last borrower moves out, has to be on a primary home, and there's no payment required. That's one big distinction. Also, it's a non-recourse loan. What that means is the only recourse the lender has is against a sale or refinance of the home when the last person moves out. So those are a few differences with a traditional mortgage. As far as how is it different than a HELOC, home equity line of credit, a reverse mortgage or retirement mortgage can have a 150-year loan term. In other words, you can't outlive it from the youngest borrower's age. HELOC charges interest. A reverse mortgage line of credit can earn interest. A HELOC can be cut, frozen, payment demanded. None of that can ever happen with a reverse mortgage. For example, let's say we have another market correction like we did in 2008 and 9, where some people lost 15 to 20% of their equity. If that were to happen again, if somebody already has a line of credit in place with a reverse mortgage, that's not impacted. There's no change to that. So there's some securities and some safety nets built in with the retirement mortgage or the reverse mortgage that traditional mortgages don't have.
Who's the ideal candidate for a reverse mortgage, and what are the eligibility requirements for one?
So anybody that wants to stay in their home, I always ask people, how long are you planning to live there? And a lot of times they say they're going to carry me out. Okay, that's good. But we want to make sure somebody's going to stay in their home for at least a couple years to recoup the cost of the loan. Somebody that wants to maintain their independence. Sometimes I'll joke with people and we'll talk about the different options. And I'll say, well, you can always go live with your kids. And they grown. They're like, look, I love my kids. I just don't want to live with them. And by the way, the kids don't really want them to move in either for the most part because they have their own lives and busy and things like that. So you have to have the right property type, single family home, townhome, patio, condominium. Even if it's a 2 to 4 unit complex, and if the borrower lives in one of the units, that qualifies. One borrower needs to be 62 years or greater. They have to have enough income to prove they can pay for the property taxes, insurance, maintenance on the home. By the way, most people qualify with just their Social Security income because we don't have to qualify them on the payment because there is no payment. The other thing is they have to have a good credit history for the last couple of years. If they don't, we can always escrow their taxes and insurance, so they don't have to worry about that either. And then they have to, it has to be their primary home. And really what they're committing to is living in their primary home, maintaining it, paying their property taxes and insurance on time. So that's kind of it in a nutshell, how people qualify.
All right, let's maybe go over an example of how this actually works. So let's say someone is 65 years old. They own their own home. They don't have a mortgage on it. It's worth let's just use a round number, $500,000. and they look at their expenses and they see, okay, there's a gap I have to make up from Social Security, and let's just keep it simple and say that's the only income they have coming in. And they come to talk to someone like you. What's the next step, and what are their options that they have to basically utilize at home in a reverse mortgage?
Sure. So how much somebody can borrow is based on three factors: their age, the interest rate, and the value of the home. So we'll just say somebody's home is worth, like you say, $500,000. They're going to be able to borrow about 35% of that, which is approximately $200,000. And with that money, they can access it three different ways. Think of it like a pie, an equity pie. They can eat their pie lump sum. They can just take a chunk of money. They can turn it into monthly payments to them, or they can have a reverse mortgage line of credit. What a lot of people do, they start with a line of credit and they can move in and out of how they access that money. So they start with a line of credit. Now they need money to buy another car, or to replace their roof. Maybe they want to take a trip or help one of their grandkids or whatever. Then they ask for a lump sum. Then they go back to line of credit. Then inflation's happened. Now they need some more money. Social Security is not enough. So now they turn on the monthly payments and they say, I need an extra $500,000 a month, whatever it is. And now the money starts going into their bank account every month. So it's very flexible. The homeowner's in control the whole time. And really what it does in a nutshell, Mark, it just gives somebody more certainty about the future. You know, the number one fear a senior has is outliving their money. And this just helps them sleep better. And I literally had a lady tell me that earlier today. She goes, well, thank you so much. Now I can sleep better at night. So that's kind of what it does in a nutshell. It just gives them access to some of their equity.
Yeah, that makes sense. Let's go a little bit deeper into each of those three mechanisms that they have, the borrower that they have to access that. Let's call it 200,000 of available, from the available mortgage. So in that line of credit example, let's say they have 200,000 available, and they take out 25,000 for whatever. Do they have to pay that back, or how does it? And when do they pay that back?
So the money's due. The money's owed when the last person permanently moves out. So they've gone on into eternity, or they've gone to live somewhere else. The borrowers or the heirs, the estate, have up to 6 months to sell or refinance the current note. Whatever the balance is paid off, and then the remainder goes to the borrower, the heirs, or the estate, however it's set up. So in your example, they have 200 they can borrow. They take 25. Now they have 175 available in a line of credit. I had one lady one time say to me, I just want all the money up front. I'm going to put it in the bank. And I said, ma'am, it's your money. You can do whatever you want with it. But how much is the bank going to pay you? Whatever it is. It's meager, less than 1%. I said, wouldn't it be better to leave it in this line of credit that's going to earn you 7%, guaranteed, insured, compound interest, that you can switch to monthly payments or lump sum whenever you need it. Within a couple of days of requesting money, it's dropped into your bank account electronically. Isn't that a better thing to just have it in the bank earning hardly anything? Now, granted, there's a couple of days delay to get the money. That's the inconvenience, if you will. But clearly, 7% is a lot better than whatever the bank pays, point something percent, 0.1% or whatever. So she ultimately did. The point is, it's very flexible, and the homeowner's in control of the funds the whole time.
And then, like in this example that we're talking about, if they did take the 200,000 and put it in the bank, right? So they're earning interest on the bank side, but are you charging them, or is the financial institution charging them interest because they've taken out that 200,000 on? So they're kind of earning it on one side, paying it on the other side, or let's call it accruing it on the other side.
Accruing, yeah. So this is a good way to think about it. Think about it like a credit card. You maybe have a $10,000 limit on your credit card, but you've only borrowed 1,000, so you're paying interest on 1,000. You have 9,000 left that you can use if you choose to, but you don't have to. Same thing with a reverse mortgage. Whatever money you draw, you're going to pay interest on, and the interest accrues each month. It grows each month, and so that's another reason to leave it in there, because you'd rather earn interest than pay interest.
Yeah. And then on the example or the way that method where you can turn this into a monthly stream, is there a possibility that they actually take out more than the house, than like the assets that they have if they, let's say, live, you know, 50 years from when they actually start this reverse mortgage?
Yeah, the way the program is structured now in the last few years, it's going to be very difficult to outlive the money because somebody's really only borrowing 35 to 45% of the value of the home. So someone would have to outlive how long the government thinks they're going to live because these are FHA-backed loans. The appreciation would be meager or maybe even negative, which has happened one time in history, 2008 and 9. They would have to pull on the money early. The interest rates would have to spike and stay high. I mean, there's all kinds of scenarios where it potentially could happen, but it's pretty unlikely that would happen. In most cases, Mark, there's money left at the end for almost everybody with how it's structured these days.
Okay. And let's continue in our example. Let's look at let's call it the backside or the end of this. So let's use our example. They have the 200,000 line of credit. They wind up using the 20,000. And I guess at some point they decide to either sell the house or they pass away and the house gets transferred. What happens then?
Yeah. So the estate or the heirs will have up to 6 months to sell or refinance the home. If the heirs want the home, they can do that. They have to pay off the existing note either by refinancing or just pay it off. Or they sell it and they pay off the existing balance. Whatever's left goes to the heirs or the estate. If they need more time, let's say it's a tough market, it's a tight market, houses aren't moving. As long as they're actively trying to market and sell the house, they can ask for extensions and they can be granted 2-3 months extensions. So potentially they have a whole year to sell or refinance the house, not have to make any payments, but they have to notify the mortgage servicer that the people have moved out, and that's when the clock starts ticking. So as long as they're communicating with the mortgage servicer and cooperating, they won't have any issues.
Okay, makes sense. In your book, you highlight some specific stories. Can you share a particularly impactful example of how a reverse mortgage helped a senior citizen, overcome a financial challenge they were having?
Yeah, I think about a couple that already had a reverse mortgage they did with me, and their income got cut. They were in a network marketing organization, and the company changed how they paid their people, and they lost I don't remember what it was, a lot of money, 60% or something of their income. And so they were racking up credit card debt because, they still had living expenses. And long story short, we had to wait for the value to get up to where it would make sense for them to refi so they could access more equity. But ultimately, the property appreciated and they pulled out something like 45,000, paid off all their debt, freed up that money each month. And boy, were they happy because now they don't have the pressure of these credit card bills anymore. And they don't have to worry about the company had changed their compensation. And they had enough money to live because they tapped into that equity and paid off that debt. So that's one story. Another one would be, I remember this family had moved from Northwest Arkansas back to Colorado Springs, which is where I live. And they wanted to live near family. And the husband wasn't doing well health-wise. In fact, he was on oxygen living at this altitude. And the wife left the room for a few minutes and he just told me, he goes, look, I need to be sure my wife's going to be okay. I'm not long for this earth. And I said, well, what does that mean that she's okay? Well, she has a maintenance-free house. She has no mortgage payment. She has a place that she can stay at and not, be able to afford it, etc. So we got them a reverse mortgage, which was just before Christmas time. A few months later, I got a call from Sharon. And she said, I don't know if you remember me, but this is Sharon. I'm like, of course I remember you. And she said, well, my husband just died. And you had told us that I could stay in this house as long as it remained my primary home, maintain the house. Is that true? I said, yes. She goes, I can stay to age 150 if I live that long. I'm like, yeah, that's true. She breathed a sigh of relief and she goes, oh, good, because that's the only way I can afford to stay. So that was kind of an act of love on her husband's part to make sure she was going to be okay. They put one large down payment down, about 65%, and then they didn't have a mortgage payment after that. So that's how it's used. There's really three ways people use them. I've given two. There's another way, access equity, which is what our example has been, and then eliminate payment. That's how most people use it, is to eliminate their monthly payment.
I think, and you hear about a lot of misconceptions about reverse mortgages, and I think people have these, things that they've heard over time, and they kind of the reverse mortgage has a stigma attached to it. What are some of the most common myths that you encounter, and then how do you address those?
Going back to the history, from 1961 to 1988, these loans were not regulated. So you have many companies around the country that were doing some type of reverse mortgage. And unfortunately, some people got taken advantage of. And in some cases, they did have to sign over the deed to the lender. But that has not been the case since 1989, when the Home Equity Conversion Mortgage Bill came into law, signed by President Reagan and Congress. And so for 36 years, it hasn't been that way. But people still think, oh, I got to give up title to my house. That is not true. You stay on title the whole time. That's the number one misconception. The other one is, another big one is, well, I must be a loser. I must be broke to get one. This is a last resort. But I'm helping people, Mark, that technically don't need a reverse mortgage. They have a lot of money, but they want to start giving away their money while they're alive, or they want to help their kids or their grandkids or their charity. So now they've got a source of tax-free money because mortgages aren't taxable. So now they tap into that money, and they're watching it do good while they're still alive. They're coaching their kids or their grandkids while they're still alive to help them with those resources. So those are the two biggest ones, I think. I give up title to my house and I must be a loser. It's a loan of last resort to get one. And both of those just really aren't true.
Well, one thing I wanted to touch on that you just brought up is the tax implications of receiving funds. So any of those three ways that you mentioned, lump sum, monthly payment, or line of credit, is there any tax implication from the homeowner if they access those funds in any of the three ways?
Anytime someone takes a loan, takes money out of their home, takes out equity, it's not taxable because loans aren't taxed. So this isn't income. This is just equity that people are tapping into, which is not taxable. Sometimes people wonder, is this going to affect my government benefits? Medicare, Social Security, sometimes people are on Medicaid. It does not, because it is not considered income. It's just money that you're accessing to live your life.
Is there any, any ways that you've seen, because we started this by talking about children being concerned for their adult, senior parents and making sure they're secure. And there's a lot of times come challenges with having that conversation with it, or children's trying to, because the parent in this case, they don't maybe want the help, or they don't want change, or they don't want to look at themselves getting older. What's the best way you've seen, or successful ways that you've seen where children are able to bring parents into the conversation about whether a reverse mortgage makes sense or not?
Yeah, it's tough because, like, the child of the senior, they have their own family. They have a mortgage typically. Their kids are growing up and they're saving for college. There's all kinds of pressure on that age group to save and make sure they have enough money for themselves. But then mom and dad might need help. And so the options are sell the house, live off that money, maybe go rent. I'll come back to that in a minute because I did an analysis for a couple one time. Ended up costing them $1.5 million if they sold and rented. They could go live with a family member, or they could do a cash out, refi a home equity line of credit, have a monthly payment, or they can do a reverse mortgage, either eliminate their payment and or access their equity that they could live on. Both examples give them more money each month to live on, not having a mortgage payment or accessing their equity. So what a lot of people come to realize is, this isn't what I thought it was. In fact, it sounds too good to be true. how can I live in my home, not make a payment, access my equity, and not owe the money until I move out? And by the way, I'm not responsible to repay it because it's a non-recourse loan. It almost sounds too good to be true. What we say is it's not too good to be true, but it is too good to be free because it's expensive. This is probably the most expensive mortgage somebody will get because these are FHA-backed loans, and the FHA loans have mortgage insurance. So to go back to our example, the $500,000 home, it's 2% of the value of the home is paid in upfront mortgage insurance. So that's $10,000 right there. They're not writing a check. It comes out of the equity. It's part of the closing costs. But that makes the loan expensive. That really is the main drawback of a reverse mortgage. Also, another one would be there's not as much equity at the end, but there is equity at the end, just not as much. So what I would say to a child of a senior homeowner is look at the options, see what's best for them and for your family. And if it's a reverse mortgage, learn about it and see if it really is going to help them accomplish what they want to accomplish, i.e. remain at home, maintain their independence, retain ownership on title, entertain the lifestyle they've worked for and dreamed of, gain access to equity, and not have to pay it back. If that's what they're looking to do, this is the solution.
All right, Kevin, that's all the questions I have for you today. I want to thank you for joining me on an episode of The Agent of Wealth. You shared some really useful tips for adult children supporting their parents through their retirement years and how their adult parents can utilize a reverse mortgage. Before we go, how best can our listeners learn more about you and your business or get in touch with you?
I might suggest they go to my website, www.reversemortgagerevolution.com. There's videos, there's a calculator, there's frequently asked questions, there's just all kinds of stuff. They can download a consumer guide, which answers a lot of questions. So that would probably be the best place. They can kind of go and look at what's there, learn more about it, and see if it might be a good option for them or their parents.
Great. We'll include all that information in the resources section of the show notes. Thanks again, Kevin, and thank you to everyone who tuned in to today's episode.
Thank you, Mark.
Don't forget to follow The Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.